If you're 6 to 12 months away from buying a home, or at least you think you might be, this video is your exact roadmap. Month by month, step by step, what to do and when to do it. Because here's the thing most people get wrong about buying a house. They wait until they feel ready, then scramble to figure out everything in 30 days. That's how people end up stressed, surprised by their credit score, scrambling for documents, or worse, watching the home they wanted go to another buyer because they weren't actually prepared. The buyers who win start 12 months out and they follow a plan. And I can tell you from experience, the difference between a smooth closing and a nightmare usually comes down to preparation. Phase 1, months 1 to 3. This is your credit and cash foundation. This is where you're not shopping for houses yet. You're not even talking to lenders yet. This phase is about getting your financial house in order so that when you do start the process, you're walking in with strength. Step 1, pull up your credit report. Go to annualcreditreport.com. It's free, it's legit, and it pulls from all 3 bureaus. You want to see exactly what lenders are going to see. Look for errors, old accounts that should be closed, collections you didn't know about, balances that are higher than you thought. If there are errors, dispute them now. That process can take 30 to 60 days, which is exactly why you're doing this in month 1, not month 11. Step 2, understand your credit score and what moves it. Your credit score is made up of 5 factors, but the 2 biggest are payment history and credit utilization. Payment history is simple. Pay everything on time, every single month. Set up auto pay if you have to. Credit utilization is the percentage of your available credit you're using. If you have a credit card with a $10,000 limit and you're carrying a $5,000 balance, that's 50% utilization, and that's potentially hurting your score. Ideally, you want to be under a 30% utilization. Under 10% is even better. Here's a quick win. If you have cash sitting around, paying down credit card balances is often the fastest way to boost your credit score. I've seen people gain 40 to 60 points in a single month just by dropping their utilization. Step 3, start your savings plan. You need to know roughly how much you will need for a down payment, closing costs, and reserves. The down payment depends on the loan program. It could be 0% down for a VA or USDA loan. It could be also 3% down for a conventional loan, or even 3.5% down for an FHA loan. Closing costs are typically 2 to 4% of the sales price. And reserves, money left over after closing. Some loans require 2 to 6 months of mortgage payments in the bank. So if you're looking at a $400,000 sales price with a 3% down payment, you might need around $12,000 for a down payment, $8,000 to $16,000 for closing costs, and maybe another $5,000 to $10,000 sitting in your bank in reserves. That's potentially $30,000 to $40,000 total. Now, there are ways to reduce that. Seller credits, down payment assistance programs, gift funds, but you need to know your target number and start working towards it. Phase 2 is months 4 through 6, documents and lender shopping. By now, you've been working on your credit for a few months, your utilization is down, your credit score is climbing, and you have a savings rhythm going. Now it's time to get organized and start talking to lenders. First, gather your documentation. Every lender is going to ask for the same basic things, so get them ready now. If you're an employee, you'll need 2 years of W-2s, 2 years of tax returns, all pages, all schedules, 30 days of pay stubs, 2 months of bank statements, all pages, even the blank ones, a copy of your driver's license, and if you're self-employed, you'll also need a profit and loss statement and possibly business tax returns. Here's a quick tip. Create a folder on your computer, label it mortgage documents, and just put everything in there. When a lender does ask for something, you'll be ready in 5 minutes instead of scrambling for a week. Second, reach out to your lender, which is myself. When we connect to get you pre-approved, I can help you figure out exactly which price range you qualify for, where you should get shopping in depending on where you want your monthly payment to be at, how much of a down payment you have saved up, and get you on the right path. If you have other questions on the home buying process, I have another YouTube video on my channel you could check out to walk through the process from start to finish. Now on to phase 3, which is months 7 through 9, neighborhoods and payments. Now you're getting closer. This is where the dreaming starts to become planning. You know your budget, you know what loan you're likely using. Now it's time to figure out where you want to live and what your actual monthly cost is going to look like. Start driving neighborhoods. Seriously, get in your car on a Saturday and spend a few hours exploring. Look at the houses, the neighbors, the parks, the traffic, the overall vibe. Drive by at different times of the day. A neighborhood that's quiet at noon might be chaotic at 5 p.m. when everyone's coming home. Research schools, even if you don't have kids yet. School ratings affect home values and resale. Look at what's being built nearby. New construction, commercial development, that tells you where the area is heading. By the end of this phase, you should have 2 or 3 neighborhoods you'd be happy living in, not just one, because in a competitive market, flexibility is power. Now let's talk about the payment reality check. Your monthly mortgage payment isn't just the principal and interest. It's also the property taxes, homeowner's insurance, and possibly private mortgage insurance and HOA fees. This is called your PITI, principal and interest, taxes, and insurance, and it's the number that actually matters. A lot of buyers focus on the home price and forget that a $400,000 house in one neighborhood might cost $300 more per month than the same priced house somewhere else, just because of property taxes or HOA dues. Run real numbers. Have your lender calculate actual monthly payments for homes in your target neighborhoods and at your target price point. And here's a pro tip, practice paying that amount now. If your estimated mortgage payment is going to be about $2,800 a month and you're currently paying $2,000 in rent, start putting that extra $800 into savings every month. You'll get used to the payment and you'll build your reserves at the same time. Now on to phase 4, months 10 through 12, lock and shop. This is it. This is when it gets real. At this point, you've done the work. Your credit is strong, your savings are ready, your documents are organized, you know your budget, you know where you want to live. Now it's time to get fully pre-approved and start making offers. Once you're pre-approved, connect with a real estate agent if you haven't already, and I'd be happy to connect you to one if you don't have a connection. Find someone who knows your target neighborhoods, responds quickly, and has experience with your type of transaction. Then start shopping with intention, not endlessly scrolling Zillow, actually touring homes, writing offers, and making decisions. Here's one more tip for this phase: ask your lender about rate lock options. In a volatile rate environment, locking your rate when you go under contract protects you from increases when you're closing. Some lenders offer extended locks or lock and shop programs that let you secure a rate even before you find a house. Now let's talk about something people don't plan for. What happens when the plan changes? Because life happens. Markets shift, jobs change, maybe you find out your credit isn't exactly where you thought it was, maybe rates spike and your budget shrinks, maybe you get outbid 5 times and start to lose hope. Here's how to pivot without panicking. If your credit isn't ready, don't force it. A 6-month delay to improve your score can save you tens of thousands of dollars over the life of the loan. A lower rate is worth waiting for. If rates rise and your budget drops, consider adjusting your target price, looking at different neighborhoods, or exploring temporary buy-down programs that lower your rate for the first year or two. If you keep losing offers, work with your agent to understand why. Is it the price, the terms, the speed? Sometimes a stronger pre-approval letter or a more flexible closing timeline makes the difference. If something major changes, job loss, unexpected expense, family situation, communicate with your lender immediately. We can often find solutions, but only if we know what's happening. The point is, a timeline is a guide, not a prison. The goal is to be ready when the right opportunity comes, not to hit an arbitrary deadline no matter what. Now, if you're here in the Pacific Northwest, especially Clark County, Washington, let me give you some local context because timing matters here. Our market has seasonal patterns that savvy buyers can use to their advantage. In the spring, talking March through May is the most competitive time. Inventory increases, but so does buyer demand. Multiple offers are common, homes move fast. In the summer, it stays competitive, especially for family buyers trying to move before the school year. In the fall, talking September through November is when things start to slow down. Sellers who listed in the spring and didn't sell are often more motivated, there's less competition, you might have more leverage. And in the winter, from December through February, this is gonna be the quietest time of the year. Fewer listings, yes, but also far fewer buyers. If you find something you like, you're often negotiating with a motivated seller and little competition. So here's how to use this 12-month plan strategically. If you wanna buy in the spring when inventory is best, start your prep in the spring before. That gives you a full 12 months. If you want to buy in the fall or winter when competition is lower, start your prep in the fall or winter before. In Clark County specifically, talking Ridgefield, Vancouver, Battleground, Camas, the entry-level and mid-price markets remain competitive year-round, so preparation matters even more. The buyers who are ready move fast. The ones who aren't, watch from the sidelines. So that's the 12-month homebuyer prep plan. Months 1 through 3, credit and cash foundation. Months 4 through 6, documents and lender shopping. Months 7 through 9, neighborhoods and payments. Months 10 through 12, lock and shop. And throughout, be ready to pivot when life throws you curveballs. If you're watching this and think, I'm not even relatively close to being ready, that's okay. That's actually the perfect time to start. 12 months from now, you'll be glad you did. If you want help figuring out where you are on this timeline or what your specific steps should be, there's a link in the description to schedule a free call with me. We'll look at your situation and map out a plan. Thanks for watching. Make sure to like and subscribe, and we'll see you in the next one.